Amazon had a pretty rough week. This week, Amazon's down about 12%. Over the past month, they're down about 10%. Now, the startling thing about Amazon is if you had invested in Amazon 1 year ago, you're actually down 11%. Think about all the stocks that went up this past year. Think about all the ETFs and indexes that went up in the past year. And Amazon, one of the most giant companies in the world, you'd be down 11% over that same time period. Over the past 5 years, we're up about 25%, but that underperforms the market. The only thing that really stands out is if you zoom out to the largest scale that we have back into the 90s, back before the dot-com bust, back before COVID, back before the great housing financial crisis, we can see that, yes, Amazon, had you invested back in 1997, you'd be up 172,000%. So Amazon's made a lot of people very, very wealthy. The question is, what can we expect out of Amazon in the coming days, in the coming months, and most importantly, as long-term investors in the coming years? So Amazon has a fantastic forward PE, 5-year forward PE at 12.0. That means if you were to buy Amazon right now, if they were to grow about 20% every single year for the next 5 years, then you're buying Amazon right now at a 12 PE ratio. Their PEG ratio is 1.4. So remember, we like to see that below 2. Below 1 is very, very good. So it's kind of in between there. We're going to compare Amazon to Alibaba. Alibaba has a forward PE of 21. Very similar debt to equity profile. Their PEG ratio, not looking too good at 2.9, well above that 2 minimum that we require. Return on equity, about half of Amazon. Return on invested capital, not too good. They do have slightly higher profit margins, but nothing too fantastic about Alibaba. Costco, looking at their growth metrics, we see a return on invested capital of almost 29%. That's phenomenal. But their PEG ratio coming in way, way, way above 2 at 4.7. And their 5-year forward PE coming in at 33.3. So they do have low debt to equity, but this is just a company that's always trading rich, always trading at a sky-high valuation, and that's probably going to hurt its growth score in a bit. Now, Google has a lot going on for it. It has a PEG under 2. We'd like for that to be under 1, but Google has a PEG of 1.9. Their debt to equity is 0.2. Their return on equity is 36%, and their return on invested capital is 30%. Solid profit margins at 32.8%. And a 5-year forward PE, it's okay. It's at 16.1. And not the greatest for free cash flow yield. But we do see Google, or rather analysts see Google coming in at 13.1% growth in their bottom line every single year for the next 5 years. Mercado Libre, we see that they have a PEG ratio of 1.2, return on equity at 41%. That's phenomenal. Revenue growth at 22%, EPS growth, some of the highest we'll see today at 30%, and finally a free cash flow yield above 7% for Mercado Libre at 7.7. Now Microsoft has fantastic profit margins at 39%, PEG ratios at 1.4, so very much in line with Amazon. We have a 5-year forward PE coming in at just below 11. We have Shopify, debt to equity, some of the best we've seen, 0.1, revenue growth and EPS growth, phenomenal numbers in the low to mid 20s. Profit margins at 16.7%. So really with Shopify, we've seen a lot of pain in that company as well, but we see that there are decent numbers for Shopify. And Target, forward PE at 15.1. That's the best that we're going to see of all these companies. Free cash flow yield coming in at 5.8. We'd like to see that a little bit higher for Target, but Target's had some headwinds in the past couple of years. And finally, Walmart. Nothing too special to talk about with Walmart. PEG ratio at 5. That's way, way, way too high. Also, we'll note that Target has a PEG ratio of 21, so that's also quite high. Forward PE coming in at 45 for Walmart. And like I said, nothing too fantastic. So if you're new to this channel, what we do is we score these companies based on these growth metrics from -10 to +10. -10 is garbage, +10 is phenomenal. And so we're going to start at the bottom and see Alibaba. Alibaba is the lowest growth company coming in at a 0.5. There's a lot of things hurting those numbers in Alibaba's. In particular, they're pretty high PEG ratio, and they're not too fantastic return on equity or invested capital. And also the fact that their free cash flow yield is basically 0. Next up is Costco. Costco coming in at 2. Not really a growth company. They do pay a dividend. We'll see that coming in the safety score. But Costco, their sky high valuations, their forward PE coming in at 47, their PEG ratio at 4.7. That's a little too rich for our blood, especially when it comes to growth companies. Walmart tied with Costco coming in at a 2. Target slightly higher at a 2.5. Shopify coming in at a 3.5. So that debt to equity, that revenue growth, and that EPS growth is helping Shopify score just a bit. Amazon coming in at a 4. That's the star of the show today. And that's due mainly in part to their PEG ratio being a 1.4 and their 5-year forward PE coming in at a 12. Google coming in at a 4.5. Mercado Libre coming in at a 5. Remember, we like when companies are 5 and higher. Even though 0 is neutral, we want to be better than neutral. We want these companies to come in at 5 or higher. And the top of the leaderboard is Microsoft coming in at a 7. So now we're going to look at some safety metrics. But before we do, if you get anything out of these videos, please like this video. Please subscribe to the channel so you can keep coming back for more finance and stock related information. And please also remember that nothing that we say on this channel is financial advice. Always do your own research and due diligence. So first, Amazon, when it comes to safety metrics, they don't pay a dividend, so that's going to hurt their safety score. We do see a PE ratio of 29. That's a little rich, but their 5-year forward PE coming in at just below 12. Alibaba, one of the best PE ratios that we'll see today. However, even though they pay a very, very small dividend, their dividend has gone down. And that's probably going to make that years of dividend growth go to 0 quite a bit once we update those numbers. Costco, PE ratio at a 54, that is very, very high. Low debt to equity, fantastic return on invested capital, but their return on assets, 9.6. That's the highest of the 3 so far. Now, Google coming in at a 0.2 debt to equity ratio. That's fantastic. Return on invested capital, 29.5. Return on assets, 20.4. That's some of the best that we'll see of all these companies. Mercado Libre comes in with a free cash flow yield like we saw earlier at 7.7%. That also will help its safety score. However, their PE ratio is 48. That's quite rich. And unfortunately, their debt to equity is 1.8. That is above 1. We do not like to see that, especially for safety. Microsoft, their return on assets is phenomenal at 17.4. Their 5-year forward PE coming in just below 11. That is that is the lowest of all these companies. Their dividend yield is almost 1%. Their dividend growth, 10.1% per year in recent years. And they have grown dividends for 20 consecutive years. So they're very close to a dividend aristocrat. Now, Shopify, debt to equity at 0.1. They don't pay a dividend, but their return on assets is double digits at 10.4%. So that's nice. Target, dividend yield, 3.9%. So with that beat down in the stock price, that is driving their yield up. They have grown dividends for 55 consecutive years. So they are not just dividend aristocrats, they are dividend kings. Their payout ratio, it's getting a little up there, but we have confidence that Target can continue paying and growing their dividends well beyond these 55 years. And they have pretty decent free cash flow yield at 5.5%. And finally, Walmart. Walmart is also a dividend king. Dividend growth at 13.3% in recent years. Their dividend yield is 0.7% with 53 consecutive years of dividend growth. So how do these numbers stack up with safety? Well, Costco comes in at the very bottom at 1.4. Mercado Libre also comes in at a 1.4 at the bottom. Shopify coming in at a 2.1. Their very low debt to equity really helps them out in these scores. Walmart comes in at a 2.9, due in part to their dividend king status and their very high dividend growth at 13.3%. Alibaba tied with Walmart at 2.9. Amazon coming in also tied with a 2.9. Now, Amazon, although they don't pay a dividend and Walmart does, we do see that they have a very, very nice 5-year forward PE at 12, beating Walmart's 29. So that's why that gives Amazon standing within the rankings of something like Walmart. Google coming in at a 4.3. Google is a recent dividend payer, and they're growing their dividends about 5%, so that's a little bit above inflation. Their fantastic return on invested capital and their fantastic return on assets is really helping Google score in that sense. Also, their very low debt to equity. Their PE ratio, 29.9. Not the best of these companies, but when we have companies like Shopify at an 82, then yeah, Google's going to come up quite above those. And second place is Microsoft at a 5.7. This is the first company that we see above 5, which is nice to see. And Microsoft just has phenomenal numbers across the board, which is why they're up there. And finally, Target coming in with a 7.1 safety score, due in part to their very low PE ratio, their dividend growth, and their dividend king status. So we rank and we score these companies from -10 to +10 to make sure that we are buying quality companies. But it's not just enough to know that we're buying quality companies. We also want to get them at a discount. We want to get them at a good price. And so next, what we do on this channel is we compute intrinsic values of these companies. And if you go down to the description of this video, you'll see 4 different links showing how to compute 4 different intrinsic value calculations. There's the PE ratios model, there's the dividend discount model. We're not going to use this for any of these companies except for Target today, the discounted cash flow model, and the Peter Lynch Peggy model. And in recent videos, we've noticed that this is rather bearish for most of the companies. And so we're going to make a slight transition in a future video when it comes to Peter Lynch. But with all these companies, we're going to do the PE ratios model and the discounted cash flow model. These intrinsic value calculators are absolutely necessary, very important tools for any investor, any long-term investor in their toolbox. So make sure you check out those links in the description. Build out your own version of these intrinsic value calculators. So let's bring it all together. So right now, the lowest scoring company is Alibaba, coming in at a 1.7. We get that 1.7 by averaging their growth and their safety. So not too fantastic for Alibaba. They're currently trading for $163 per share. Intrinsically, using those intrinsic value calculators, we see that Alibaba is probably worth about 137. And so that gives us a 19% premium on Alibaba. Next up is Costco, also coming in at a 1.7, higher growth score, but lower safety score. And we see that we are way, way off. The price is currently $1,000 per share, intrinsically $600. That gives us a 67% premium on Costco. So according to these numbers, according to our calculations, we would not buy Costco until it gets down to $510 per share, and we would buy very, very heavy at $390. Now, Costco is one of those companies that it's never, ever, ever going to deviate away from its price. It's always basically trading at fair value. And so intrinsically, when we look at the numbers, we remove sort of the freak nature of Costco, and we just look at the numbers, the discounted cash flow, the free cash flow, the PE ratios and whatnot. And we don't really take into account the fact that Costco is just a company that everybody wants, and it's just steady growth for Costco. So Costco might be something that you want to make an exception and say, well, maybe we'll buy at $800 per share. And we can kind of throw these out. These intrinsic value calculations, these are not exact. It's not a science, it's more art. And that's something that you want to take into account when you look at a company like Costco. Walmart also trading at a very high premium. So they're coming in with an average score of 2.45. That's not anything that we would be interested in. Remember, we want companies that score 5 and higher. And that's neither for growth nor for safety. When in the case of Walmart, intrinsically $75 per share. They're currently trading for $131. That's a 75% premium on Walmart. Shopify, same idea. So they come in with a 3.5 for growth and a 2.1 for safety. Intrinsically, we think that they are $70 per share. They're currently trading for $112. That's a 60% premium that you're paying for Shopify right now. Average score of 2.8. So also not something that we would be interested in. Now, Mercado Libre coming in at 3.2. So again, not at 5, but we are seeing a margin of safety of 24%. And so if this is a company that you had to have in your portfolio right now, this might be something where you ignore the average score of 3.2. As a matter of fact, the growth score comes in at a 5. So that does tip the scales in its favor if you wanted to make that argument. And you would be getting Mercado Libre right now at a 24% discount, 24% margin of safety compared to its current stock price of $1,970. Amazon coming in a little bit higher at 3.45. After the sell-off in Amazon, after the beatdown in the stock price, we see that Amazon is currently trading at a 19% margin of safety. Current stock price is 210. Intrinsically, we think it's 260. So that's good news for Amazon. If you want to buy Amazon, buy under 221. And if we wanted to buy at a 35% discount, we would buy Amazon anytime it gets to 169 or lower. Google comes in with an average score of 4.4. So again, not at that 5. And also margin of safety, it's trading about fair value. It's trading for 323. Intrinsically, we think that it is worth 300. Target comes in with a margin of safety of 34%, and they're so close to that average score of 5. Their safety is phenomenal at 7.1. So their current stock price is 116. We think that it's worth 175. So we would buy Target at $149 per share, and we would buy much more heavily if it ever got down to 114, which it almost is. And so if Target goes down a little bit more, if this is something that we wanted to have in our inner flame finance portfolios, this is something that we would consider adding. And the best company of all is the only company that has an average score above 5. Its growth and its safety score are both above 5. Currently trading for $401 per share. Intrinsically, we think that Microsoft is really worth $580. That gives us a 31% margin of safety. So of all these companies, Microsoft seems to be the winner. Amazon, not looking too bad. I mean, we could argue that their score could be a little bit higher, but now that there's a beatdown in the stock price, it is such a solid company that Amazon almost at a 20% margin of safety. It might be something to consider buying. So there you have it, folks. Let us know in the comments below what you think about any of these companies. Are you buying or selling any of these companies? Are you holding off? Are you waiting for the stock prices to go lower? What do you think about the current economic climate? What do you think about the stock market in general? Crypto's been crashing. Software companies have been crashing. Let us know in the comments below. Thank you very much for watching. Again, if you got anything out of this video, please consider liking, subscribing to the channel. That would really help us out. And we appreciate you being here, and we'll see you in the next video.